Thank you everyone for joining us for this webinar. As we end 2020 and start 2021, we thought what better way to launch the year, but to do a quick recap. And we will test some of the hypotheses people had 6 months ago about the market and what it really turned out to be, and also looking into the next year. And wondering how we see it pan out, given that it's been a year of COVID and vaccines are probably not coming, at least for somebody like me, till the end of this year, for sure. How will that impact the current market? And hence what it means for real estate. Should people buy, not buy? Like that question is out there. Should I buy in Hamilton? Should I buy in downtown? Downtown is at an all-time low. And should I buy at all, or should I just rent? Because the rents have gone down from, say, at 2,500 for a downtown one bedroom to now 1,600 for a downtown bedroom. And so those are the questions that we will discuss today. I am excited and glad to welcome all of you. You're all experts, people I respect a lot. And it's super cool to have such accomplished and knowledgeable people all at once. So let me start with Nigel. We have some of your forecasts from our last webinar noted down, and we'll come back and ask you about them. But Nigel is an investment analyst for Veritas Research, and he is well recognized StarMine top analyst year after year. So he's one of the Bay Street star analysts, and he's been very knowledgeable and contributed to our webinar in the past as well. Second, we have Raja. Raja is the owner of Home Life GTA Realty, an engineer by profession. Raja has been in the industry for over 25 years, and he's not just running a brokerage company. He is a very active real estate investor, a builder, and he's probably the most progressive and innovative thinking person from a brokerage side that I have ever met. So welcome, Raja, to our event as well. And of course, we also have with us Brian. Brian is the founder of Insightt. It is a real estate data analytics company. It's a unique insight perspective that the company brings. It's the next level real estate insights to be exact. He has great experience at organizations like F&F Canada, Carson. He was part of CMHC. And so he knows the whole cross-functional setting across financial services, insurance, and real estate. And with that, I open the floor to all of you guys. Thank you all for joining.
Our pleasure.
Thank you. Thank you.
So let's start with the first question, which is kind of like the overview mothership question. What was COVID-19's impact on 2020? And was there anything that surprised you about the housing market? And Raja, maybe I'll start with you because you were in the thick of things.
Thank you. Actually, yes, this is a surprise to us. COVID-19 has impacted a lot of our business. COVID-19 was announced in the first week of March. The Ontario government announced lockdown starting from March 18, 2020. When lockdown was announced, offices closed, schools closed, businesses closed, Canadians were scared and stayed at home. Real estate market almost became a standstill. Nobody knew what to do. Half of March, April, and May, real estate market almost a standstill. June 2020 market started move slowly. The full month of April 2020, real estate sales were down 67.1% compared to the previous year, April 2019. But the price did not change much. May 2020 compared to previous year, 53.7% down. And June 2020, only 1.4% sales down. Due to these effects, the Bank of Canada nervously reduced the interest rate drastically to 0.25%. This is historically low rate. This rate is very attractive and very low. People who lost their jobs were mostly blue-collar employees. Unemployment rate went up. Regardless, 15% of the people, normally they don't buy the properties. From June, July, August, September onwards, until December 2020, price and sales shot up. Market never looked back. End of 2020, sales were up 8.4%, and the sales price up 13% compared to 2019. Stats produced by Condo Regional Real Estate Board highlighted average price were 929,699, and number of sales was 95,151. Finally, the COVID year 2020 became the record year in the history. Whoever can afford to buy, the low interest rate makes them to jump into the real estate market. Low inventory, supply shortage, not enough listings, high demand. Look like those who were sitting on the fence have finally decided to jump in. Also, there are some investors, they are looking the deals. From my experience, I can say something. In 1989, the average price, house price was 289,000. And after that, almost 9 years later, the price dropped to 198,000. Because I was in the market, I'm talking from my experience. Because of increase in housing inventory that time, now housing supply is very low. For example, if you take some part of Toronto, we call in real estate municipality, we call say E11. That area included from Steeles Avenue to Highway 401, Markham Road to Pickering. This is one area just for the example I am taking. In this area, we have only 6 units available for sale, including 1 detached house. And out of 6, 2 of them already conditionally sold. Generally, this area, more properties available compared to the other part of Toronto. It shows market is so very tight. This not in Toronto or surrounding area, but also extends to further north, east, and west. Recently, many of you know that IMF instructs their member of countries to spend as much as can to boost the economy. It is quantitative easing, it is cheap money, inflation will be high, of course the price will go up. In my personal opinion, there's no reason for price to come down for the next 2 years, unless otherwise government do any policy changes.
Talking about quantitative easing, what do you think, Nigel? Is this quantitative easing that is kind of quasi-quantitative easing that is leading to these numbers? Thank you for those numbers, Raja. That makes me scared of the real estate market. If prices are not coming in, what happens to, because my salary isn't going up. Far from it. Like COVID has only eaten into people's salaries.
Yeah, so I think, going back to what's different this time, I think the key difference is extensive government fiscal stimulus, right? So in past cycles, we've always had monetary stimulus. We've always had rates getting cut. We've had central banks intervene in financial markets to support asset prices. That is new. What is new this time is governments have directly provided money to households and businesses, right? So because of that fiscal stimulus, the typical link we have between the economy and the credit conditions for businesses and households have been completely broken, right? Unemployment went up significantly, but delinquencies didn't go up. Businesses can operate, but business insolvencies aren't up. They're still at cycle lows. And if you look at the level of stimulus, right, the amount that the government stimulated in Canada was so much that disposable income actually went up during COVID-19. So the amount of money that households received was more than the amount of wages that was lost due to COVID-19. So they've actually overstimulated. And that, I think, is the key difference. And there's other implications from that I can get into later. But if I had to single out what's really surprised me, it's how fiscal stimulus has completely distorted the link between the economy and financial and non-financial markets.
Interesting. Brian, what are your thoughts on this?
I agree with both. When you look at this year, it was really a roller coaster. So I think Raja hit the nail right on the head. When we looked from January and February, we were expecting a blockbuster year. We got into that March to May timeline, and then all of a sudden we became the biggest bears, and the housing market was going to crash. And there was no way anybody who put money down would have said we would have never beat 2019 numbers. It was just, it was so far and so distant you would never catch it. And lo and behold, we get into June and things dramatically change, and it continues to be more of a bullish market as we move around it. I think what was surprising was obviously the housing market performance, but there was two phenomena that really happened. And when we look at it by property type, I'm actually going to show what happened with condos and what happened with detached homes. And there was really that exodus effect out of the GTA. So, you know, for the first time in a long time with condo apartments, we actually seen a decline. And so the bigger graph actually shows for the entire GTA. And what we did was we wanted to break out the Halton region, which is your typical 905 type of community, and comparison in contrast to the 416, or right, that downtown core. So you saw a dramatic price decline and that exit coming out. So you saw prices going down within that market, whereas in the suburbs, the actual price for the condos went up. When you look at the detached homes, the trajectory is wildly high when you look at the Halton region. And it's the same that's happened in the east end of the city and in the north. We've seen rapid acceleration. So detached has followed a very different trend. So when we look at the market, we tend to basically just look at the aggregated market, but the property type really gives us big clues on what's happening within the marketplace. And I think the one that I never expected to see happen was the rental market. The rental condo market in downtown Toronto, we talked about it earlier. We just showed the curves around what happened in the entire GTA, but what happened in Toronto. So it's that exodus out of the core that we were seeing. Halton, and when you look in the Scarborough areas, and even on the Whitby and Ajax, they haven't seen as much price depreciation on the rentals for condo apartments. So just interesting stuff around the data that we didn't expect to see.
Right. I think Raja gave us a good head start with all of those statistics and sharing from his experience, 89 versus now and the fiscal stimulus. I think that kind of sums up 2020. Is almost a surprise. Every quarter was a new quarter, so to say, for people in this space. But talking about that, have certain Canadian markets done better or worse than others? You talked about the type of houses, and in fact, we at BuyProperly have an AI model that we use to value properties and track what's performing under and above the market. And we could kind of see this coming because we could see that they have the fair market value estimations for regions have started going down. And in fact, my data scientist was like, I'm looking to buy a condo, and my model tells me that it's going down. I need to make it accurate and make sure I buy the right condo. But then the detached houses market went crazy. What about geographies? And Raja, you're in the thick of things. So are there certain areas that responded better or did worse off than others?
Can I answer?
Yeah.
Okay, what happened actually, the market, you're right, the sales of low rise went up. The reason is, meantime, the downtown condo sales price, monthly rent came down quite a bit. And also real estate market always cycle. We've seen it whenever the low rise goes up, later on it come down, condo goes up. Same thing, it happens recently because of these people, the offices closed, university closed, everything, the people went out, they stayed back with their families. The foreign students, they went back their countries. That's the reason downtown condos were mostly become vacant. So people move out. Now we see in last few weeks, actually the market little changing. The low rise coming a little slow. No, I shouldn't say slow, but the high rise condos price going up and open market. If you check it, one of the condo, if we check yesterday, only 3 units available. Before it was over 25 units available. See, everything changing. As we know, the cycle is changing. See, what happened now, pandemic has taught us a new way of life. People are working from home. Classes are online. Many meetings are held via Zoom or virtual platform. Therefore, people are willing to move anywhere in Ontario for spacious houses. This will lead to 15-minute cities. You know that 15-minute cities, I think most of you guys know how it works. This may be the future. Many European countries has been already started 15-minute cities. So some island countries are also promoting free Wi-Fi, low accommodation fees to have people to work and do business move to their own countries. So it will happen, what will happen eventually, and also what is now, I believe most of you that in October, the federal government announced a plan to bring 1.2 million immigrants to Canada in next 3 years. In the past, Ontario and Greater Golden Horseshoe specifically had received over 50% of Canada's immigrants, which means that the region could see 600,000 more people joining our neighborhood from that alone. So the plan expects that 60% of those new arrivals will be coming through the economic class, which means these new immigrants or new residents with economic and business assets to put to work in the communities. What will happen? So as soon as they come, they mostly move into downtown, mostly the cities. Each and every country, mostly they promote at least 2 or 3 cities, especially in Canada, Vancouver and Toronto. So when the people come into Toronto, what would they do? They buy the condos first. So Khushboo, you may have a challenge to buy condo very soon. And also, of course, everything goes up. Last, if you see it after the pandemic, groceries went up 30%. Labor cost went up 30%. Material went up cost 30%. How the builders can sell the properties lower price? There's no way they can sell a lower price. So only way the price goes up. So
that's scary. That's scary. I think the whole of last year we were hoping for the market to bottom out so that we can kind of buy into this. And Nigel, coming back to your previous webinars forecast that Q1 is where we might see some sort of a mortgage cliff, hopefully in the condo market, given that the debt levels are high. And yes, federal government is pumping in money, but then that will stop at some time. It didn't for a long time. So revisiting, do we still see the market bottoming out? Or as Raja says, there's no more room for it to go down, it can only go up. And we have a question on that note also throwing your way, Nigel, is that the current household debt is at 170%. How will it even sustain itself?
Yeah, so there's a lot to unpack there, and I'll try to doing it step by step. So I think the first step is, touching on where the financing is coming from, right? So the way we looked at it is, let's put deferrals aside for a second. Let's just talk about where's the buying power coming from right now in real estate. And what's happened during the pandemic is a lot of households are now spending less. So consumption has gone down because they're saving on going out or eating out or entertainment, whatever it may be. And what we suspect is happening at the moment are that households are looking at their current rate of spending, which is lower, and they're looking at that additional income that they have now that they didn't have previously, and they're allocating some of that income to higher monthly mortgage payments. So for example, the average household in Toronto, let's say, in Canada, we estimate the average household saving about $800 a month now during the pandemic from lower consumption spending. But in Toronto, it's likely higher because higher income households are probably saving even more than that. Let's say it's $1,000 a month that they're saving now that they didn't have before the pandemic. Now, households can do a few things with that money. They can pay down debt, which a lot of Canadians have because credit card balances have declined from over 80 billion at the start of the pandemic to closer to 70 billion now at charter banks during the pandemic. So Canadians have paid down debt with the excess income. Another thing they can do is they can buy more stuff, but that's not likely to happen because of the mobility restrictions during the pandemic. So even if you want to spend money, you can't. The third thing they can do is put money into financial assets like stocks, bonds, ETFs. And you're seeing in the States, that seems to be the main source of excess stimulus money. A lot of the stimulus money in the US is going into the stock market. So you're seeing a lot of stock market price appreciation. In Canada, it's different. What are Canadians doing? They're taking a portion of that excess income and they're buying houses and they're buying cars, right? So auto loan debt is increasing during the pandemic and mortgage debt is increasing at an incredibly fast pace during the pandemic. So to give you an idea of this, for every $100 increase in your monthly mortgage payment, you can qualify for about $18,000 more in mortgage credit, right? So that's what you qualify for under the qualifying rate, which is about 4.8%. Now the actual mortgage rate, which is a little bit below 2%, it actually translates into about $25,000 in additional mortgage credit. So if you're a household that's now saving $1,000 a month, and you want to put 500 of that $1,000 to a mortgage payment or an increase in the mortgage payment, you're looking at another $100,000 to $150,000 in additional mortgage credit. So if you look at what's happening in the real estate market right now, we think this is what explains the increase in buying power, because you're not just seeing a rotation out of the GTA into the suburbs. If you were, you'd see prices come down across the GTA and then go up outside the GTA because you get a normalization of price. What you're actually seeing is prices go up in the GTA for detached and outside the GTA as well for detached. So what's happening is households are taking on more mortgage debt, and they're taking more of their income that they're saving and putting it towards a mortgage payment. The problem with that, though, is that once the pandemic ends, the money that's going towards the mortgage payment, it can't go back into the economy. It's gone. It can't be spent anymore, right? So in my view, I think that the pendulum might have swung a little too much in one direction. I think Canadians are overestimating the permanency of work from home and the permanency of the spending levels that we have during the pandemic. It's not going to be the same level of expenses you have now. It's not going to be the same level of expenses when the pandemic ends. So for now, we think there's still demand for real estate markets and for prices, and the demand is only limited by the amount of additional mortgage debt that Canadians are willing to take on and the amount of additional mortgage debt lenders are willing to underwrite. So until we reach a limit there, I don't think you're going to see any weakness in real estate.
Got it. Brian, anything you want to add? Thank you for the very logical explanation, Nigel.
Yeah.
Could I not agree with Nigel? And Raja, it just makes sense. What we really saw is that exit from the condo market, and what we're seeing is the suburbs are just incredibly hot now. That chase of the detached home, the people that are living in condos can't afford a detached home in downtown Toronto area, so they are pushing out to the outer boundaries, which is what we're seeing, that call to the welcome to the suburbs. We're seeing a whole bunch of people making humongous lifestyle changes, which is similar to what you see in the US with people telecommuting. So companies now with the work from home are actually, people are saying, well, why wouldn't I live in Collingwood now? This is my chance to actually do that. So we talked to a couple of brokers yesterday in the Collingwood market, and they're like, we have never been so busy and we have such low inventory and prices are going through the roof. And then we also talked to some brokers out in the London market and a lot of the country properties, and they're seeing the exact same. They're seeing that they're flying off the shelf. Properties that would normally sit on the market for 150, 180 days are coming up with satellite internet now. There's a whole dynamic and change to the rural market as well, that people are saying, I want to live there for the lifestyle reasons. Same thing with cottages. Cottages across the board have just been hot because people are now even leaving their house to work directly on the waterfront. So that's been the big shift that we've seen, and it's COVID has made that now possible because of more flexible employer ability to work from home.
Yeah, I mean, we at BuyProperly, we are a fractional real estate platform, so not principal residences as such. But even on our end, I think we've also moved a little towards the suburbs. So we brought on a property in Hamilton, which went crazy. It had so much interest. And then we just recently also added a property in Welland in the Niagara region. So we are seeing people kind of moving towards suburbs, saying that, hey, probably with COVID, I'm at least working from home for the next year, and then we will see, which is making it interesting because a lot of companies might not go back 100% to the city center. That's one place where, Nigel, I think I may disagree that people are overestimating this work from home scenario. It might be here to stay in some form. It will change a bit, but a lot of companies now are open to saying, okay, if you want to work from home 2 days a week, that's okay. Or let's just move to 3 days a week in office and 2 days from home for everyone, kind of a setup. So that's kind of what's in my mind can make it sticky, which is why we when we choose property to bring on the platform, we try and say, hey, let's see, there's certain elements of this current pandemic that might just change behavior for longer term, and which means that people want to also not just move to suburb, but also want to have like home offices, because having two people working in the same 2-bedroom condo is not a realistic or a pleasant option if two people are in the meeting at the same time in adjacent rooms. So, which means everybody wants to have their office corner, and it's not as easy to do that when you're in downtown Condo. That's the kind of tricky piece.
Yeah, so if I could jump in there,
Yeah.
just a quick point on that. I agree that work from home is going to be permanent in some capacity, right? So I think it's fair to say that we will have work from home at least partially, 2, 3, 4 days a week. Hard to say, depends on the job and the industry. But the point being is that Canadians may be overestimating the level of work from home. So work from home might only be 1 or 2 times a week, not 1 or 2 times a month, or 7 days a month, for example, right? So if you get that assumption incorrect, if you're assuming it's once a week maybe, and it's actually 2 or 3 times a week, it changes your cost structure, changes your cash flow basis, because your expenses are going to run higher than you expected. You're going to get a lot more transportation costs. The commute inconveniency of living in the suburbs might be a lot more higher than you anticipated if you have to go into the office 2 or 3 times a week as opposed to once a week, right? And a key part about this is also the K-shaped recovery that people have talked about during COVID. So the K-shaped recovery means that you have people that are in COVID impacted sectors that are still feeling pressures due to COVID-19. And those are mainly renters, right? Renters tend to be also the ones most impacted by COVID-19. And then people that are more affluent, more white collar, they have done actually really well during COVID-19, and they've actually increased their net worth for the most part. So those are the people that are also more likely to buy detached houses. So that dynamic is what's driving the differences, I think, in the real estate market as well. You're seeing rent prices come down because people that rent are still impacted, but you're seeing housing prices go up because people that buy aren't as impacted by COVID-19. Now, the problem is those people that are buying, they may be, it depends on their individual situation, but they may be overestimating the amount of time they can actually work from home, right? So they could be, the pendulum always swings a little too much in one direction and then comes back a little bit and then it finds the equilibrium. So it's probably gone a little too far in one direction and it will come back, but we won't see the impact of that until the pandemic ends. So talking, back half of this year at the earliest.
The other big question is the mortgage interest rates. And we all know that having low interest rates helps people convert towards becoming a buyer, because if I'm going to have a rental of 1,600 and a mortgage payment of 1,600, I'll probably choose the latter and be a homeowner instead. But how long, and maybe Nigel, you are most probably the closest to this factor, how long do you think these low interest rates are going to last, given that we do have a vaccine around the corner?
Sure. Look, the Bank of Canada is not going to raise its interest rate. So they've stated that they expect rates to remain low until at least 2023. So if we do get higher rates, it's not going to be driven anytime soon, and it's not going to be driven by the Bank of Canada policy, right? So higher rates have to be driven by market conditions. So the majority of individuals that buy and sell government bonds, for example, or hold government bonds, think inflation is going to increase. And Raja mentioned inflation is going to be pretty high. If inflation expectations continue to increase, at some point that's going to be reflected in government bond yields. So government bond yields are going to go up because investors are going to anticipate higher rates of inflation. And even though the Bank of Canada policy influences pricing and interest rates, ultimately banks are going to look at the market yields. And one of the market yields they look at is the 5-year government bond. So if the 5-year government bond yield goes up, you can't price mortgages below the government bond yield. It doesn't make sense, right? You have to price mortgages at a bond yield. So if the market thinks inflation is going to go up, and if the market starts selling government bonds because of that, and yields go up for government bonds, that could translate into higher mortgage rates. But we're not going to get higher mortgage rates from central bank policy, at least not until 2024.
Right.
Yes, and also, as he said, right, the interest rate is so low. If you take 5 years rate, if the owner occupied only 1.48%. So when you pay 1.48% or 1.5%, what will happen? Over 50% of our payment going towards the principal amount. So the saving will be much higher than before. We never heard of this one. So before, I remember still the rate was very high. So most of the, in the beginning, most of the portion of our payment goes towards principal interest, sorry. Now is most over 50, almost 55% goes to principal amount. So that way, so if you take in 5 years term, your most of the, at least big portion of your principal paid off. So this is even though the after 4 years or 5 years, the rate goes up, still they can able to manage. And also, see, the thing is what happened now, because our life changes, economy change, and also municipalities should think or will consider to change zoning by law to accommodate friendlier neighborhood. That what happened now, we don't have enough supply. The reason how they can bring more supply is only the city or municipality, they have to do some kind of changes. Unless still we're going to have the same situation. More people come to the city or our greater GTA, but we don't have enough supply. And also people, if they live in the same house longer, they don't want to move out because of this pandemic. So they stay in the same house. Only the people who are renting, they want to buy it, where they can buy. As Brian said earlier, even our agent goes to up to Bowmanville, they have 30, 35 offers. They are fighting for one property, 30, 35, even the north, Bradford, Brantford, Kitchener, everywhere the same situation. Not only, maybe the city of Toronto may be expensive now. The average price went much more than 1 million. So that's the reason people going around. So I believe, and as you said, 2 to 3 days per week, employee will work at the office and the rest of the week from home. The future will be something different. Mostly the EV automobiles or drone deliveries, flying cars, autonomous vehicles, and that way less vehicles on the road. So even the people working far, if they want to come to city 1 or 2 days in a week, the expenses not like before, because everything will be cheaper. Because before maybe 2 hours, maybe you may be on the street. The future will not be that much. So this is, I believe the pandemic already changed our life. It leads to our life in the same direction.
Brian, you would like to add anything to this?
Of course, I agree with Nigel on this one. The rates will stay low. The excitement in the market in the fall around the low interest rates got people out in droves, but house price appreciation has diluted that so quickly that it's forcing that periphery push outside. So while they were excited, they can't get the 1.5% interest. The reality is that they wanted to live in Oakville, they're living in St. Catharines, they're living in Niagara in the periphery market. So it's really just coming back to that affordability. So yeah, awesome. You're paying lots of your principal down, but the reality is you're not living where you want to because house prices are growing so darn quick.
Right. And with the vaccine coming around, and that's something on everybody's mind, what does the expert panel here think? How will that impact investor confidence? So yes, last year, savings, cash, plus mortgage interest rates led to a lot of buying. Now you have vaccine coming in. Does that mean that people are going to be more excited about saying, hey, let's go to the restaurant and spend it on a fancy dinner? Or are they going to plan and say, you know what, this saving thing was really nice. It allowed me to buy a house. Let me continue to stay home and cook my own food and just save up and buy more investment products. And how long are we going to be in this current state? Nigel, do you want to kick it off?
Sure, yeah. So let's talk about savings first. So we estimate that households have saved about 148 billion since the pandemic started. So on a per household basis, that's about on average $9,000 per household. Now, again, that's on average, right? You'll have some households that are saving a lot more, some households that are saving a lot less. And just going back to real estate, right? So the reason that per household number is important, at least it tells us that it's not likely that the increase we're seeing in real estate is being driven entirely by savings. Like if you save $20,000, that doesn't mean you can convert that $20,000 into $100,000 purchasing power. That just improves your down payment and whatever mortgage you qualify for. So it's not really the savings that are driving real estate. It could be driving a pull forward of demand from first-time home buyers that can accelerate the savings they need for a down payment, but it won't really be driving the purchasing power. So the question really is, well, okay, when the economy reopens, how does savings normalize again? And the savings that people have left over when the pandemic ends Part of that will be spent on big ticket items, perhaps travel and maybe some other big ticket luxury items. But other type of service items, you can't increase your spending. So if you got one haircut per week before the pandemic, you can't start getting 2 haircuts a week after the pandemic ends, right? Like there's a certain amount of service spending that can't be made up for. It can't have pent up demand because you're not going to eat 2 meals at a restaurant now after you ate 1 meal before. So a portion of that savings might be drained. We think actually what's going to happen is the savings will either go to pay down debt or it will go into investments, right? So I don't think Canadians are actually going to exit the pandemic with a lot of excess savings. The big question will be, how does spending normalize? Because if people are putting more money towards the mortgage payment, which we think is the case, and we can confirm that once more data is released over the following quarters, but if that's true, then a portion of the spending that we had before the pandemic is never going to come back, right? And the only way it can come back is if Canadians start taking on more debt. So either credit card debt, or they start borrowing against the equity in their house and using that to finance their lifestyle. So we could see either an acceleration of household debt when the pandemic ends, or we could see lower consumption, like a brief increase from savings being spent, one-time expenditures on travel, for example, and then a kind of quick decline again to lower levels of spending, or you're going to see an acceleration of debt. So something has to give, because households are still making a finite amount of income. They're not making infinite income. The income can only be allocated to certain avenues. So we think after the pandemic, it's going to be an interesting environment where you could actually see perhaps the pendulum start swinging the other way, and we'll actually get a better understanding of how permanent these work from home trends are, how sticky they really are, and what the dynamics will be for households. Are they going to be coming into the office once a week or 3 times a week? So based on how that normalizes, that's going to have an impact on spending, and we also think on the real estate market.
That's very interesting. Yeah, I think on our end, we are hoping that some of this savings sticks and people start thinking about real estate investing more, because like the whole purpose of our platform is to say enable people to be participating in the real estate market even when they don't have tons of cash. And I think this is a good opportunity right now to enter the real estate market. If you're not buying the full property, buy a fractional, but enter the market with whatever you can, because people have that spare cash right now and nowhere to spend, like you're saying, in simple terms. They have the cash in hand, they might as well put it into an investment asset class like real estate through platform like ours, or if they can afford the whole property, then yes, go do that. But at least it will ensure that they get into this asset class and not stay only in the frothy stock market. So definitely something that we hope, and we've seen an increased interest in our platform as well, especially earlier this year, like come Jan, we've seen a lot more people clicking across investment properties to say, hey, let me enter the real estate market and add this asset to my portfolio, because stocks are actually, frankly speaking, already very expensive because of the increase in prices that they had last year, and nobody knows if it's going to stay that way. But talking about investor confidence and vaccine overall, Raja, do you and your company see this in reality? Like when you talk to people and meet customers, are they more bullish with the vaccine coming in that things are going to change? So let me go buy because maybe the prices will go up once people are excited.
Yes, actually the vaccines give confidence to the buyer, but we are already in tight market situation. What will happen once the border opens and students are back to university and immigrants are starting to come? The downtown condo situation will rapidly change. All the people, they take the rent. So most of the units will be taken by these people. So I believe this confidence level, the market will boost again. It will go further up. The rental market now, as I said earlier, it's about 25 to 30% rental market went down, right? The rent is used to be 2,000. Now we are getting only 1,700. But once this vaccine gives, then everything changing. It will change.
Okay. Brian, what do you think? How does the vaccine impact what people are thinking or feeling?
You know, COVID-19 has really caused people to reflect, and your comments are timely around wanting to get into the real estate market. I think more and more people have said this was something I've been wanting to do. And now that I have this incremental funds that I can start allocating to it, that's why we've seen such a resurgence into real estate investing all of a sudden. I think, you know, the optimism around the vaccine is really going to come down to property type, and it's the condominium units are the one that's going to feel the most impact, and the optimism not to have to stand at the elevator for 45 minutes because you're only allowed 1 to 2 people in. Once you get the return to work and the vaccine starts to bring that back to normal, Raja's right on the mark. You'll see the condo market bounce back very, very quickly around it, and people will start to emerge back because that's your affordable price point. So yeah, I think there's a lot of optimism around it. There has to be. Otherwise, nobody wants to live as we currently are today. So.
Okay. Yeah. On that note, let me ask the people what they think about investments and how has their thought process been, and whether COVID-19 has deterred them from making investments or not, or maybe a little bit. I see a bunch of no's coming. That's super interesting. We'll keep this open for a minute. It has been quite a roller coaster year, both in terms of emotions, the markets, including real estate, and it doesn't have a lot of precedence. We've compared to Spanish flu in a lot of places, but this has been different. There wasn't as much government action, I believe, at that time. And with quantitative easing in 2008, everybody knows what to do. Just flush the economy with cash and things are okay, which is what we see now. All right. Interestingly, more people think that it hasn't deterred them from making investments, which probably reflects in the prices of real estate as well as the stock market, actually, which has been pretty frothy and going up. Cool. There's a question from the audience. So after spring 2017, when interest rates were low, the government brought stress test and foreign buyer tax, which led to 7 to 10% correction in some GTA areas. Do you see similar areas where government intervention can happen given the sharp rise in unaffordability? Sorry.
If you don't mind, I can take this.
Sure.
Yeah, the government, CMHC in particular, has really changed their mandate around that. If you actually look, they released something called the Housing Supply Challenge. So the government's actually putting up $350 million around how do you find more affordable housing solutions. So CMHC has made a dramatic shift in mandate from really being that like a private sector operating in the insurance vertical into back to our social housing mandate. So I think you're going to see some interesting things come out of the government in the next 3 years around how are they going to leverage data more affordably. Back when I worked at CMHC some time ago, we did all kinds of affordable housing projects around affordability and using land lease structures, and many do and private sector. So CMHC actually has an innovation department and actually looking for ways to include the private sector and even venture capitalists around how are we going to solve this affordability challenge. So I think, yes, we're going to start to see more stimulus. We're going to start to see more ways that they could actually help with the affordability challenge.
Nigel, do you want to add something?
Yeah, sure. So from my end, the only avenue I could potentially see where the government tries to address lack of affordability in housing is pursuing numbered corporations, right? So if they're concerned about who the beneficiaries are for numbered corporations that purchase real estate, they might pass a law where that's clear, and that's more of a measure where they want to push back against potential money laundering or foreign capital investments that are not, let's say, above board or legitimate, right? So that might occur, I think, as a potential option. But outside of that, I don't see, the Bank of Canada raising interest rates, and I don't see the government pulling back stimulus until well after the pandemic is over. So I really don't think if we are going to see a price correction in real estate that it's going to be driven by government policy. I think it will have to be driven by changes in the economy or changes in the dynamic of household finances or market conditions.
Raja, what's your take on this?
Yes, sir. What we see, I seen it whenever the market goes through the roof, government come bring with some ideas. Same what you said earlier. We had the same issue 2007 and 2008. We had the same situation. Price went up from 1998 all the way to 2007. The price went so much high. From then, what happened? Government brought they increased the interest rate. Then 2007 and 8, as everybody knows, there was a big market down. Then the interest rate came down. That time, the finance minister, Jim Flaherty, brought the interest rate so down. Then suddenly the real estate market went up. Then 2017, as I said, they brought the real estate market from 2008 to 2017 went up. Then they brought the stress test. Then brought down the market again. Some places you said 78%, some area more than 30% also came down, especially the new area. Same thing now. After that, until last year, except those 3 months, market goes up. Whenever it comes to certain level, then of course the government brings some kind of policy changes, then bring them. They want to make a balance, right? That's what we need. Otherwise, that even you bring it or not, but normally the real estate market every 7 to 8 years the price down. Normally, if you invest in real estate long run, see, if you ask me the real estate investment, this is always long term. If you want to buy a property now, if you want to live there, don't worry about the timing. So you're going to live there. As long as you can able to afford to pay the mortgage, then you can buy. If you think for investment, then you have to take a decision. Is it you want to go high rise or low rise? That you have to do some calculations.
Got it. Yeah, on that note, so now that I have 3 such solid data-backed experts on the panel, question for you guys is for our audiences, are there any tips that you would have for people on where you think they should be buying? Is it detached or a condo, suburb or downtown? Are there any tips? And Brian, maybe we start with you this time.
Sure, thanks. Doesn't matter pandemic or non-pandemic. The way I look at buying real estate is always around the affordability. So as a real estate investor, we buy a number of properties, with clients, and we advise on a lot of clients around it. So it's looking at that affordability and where is that thing. So the markets that I personally like and doing lots of research is the St. Catharines market, the Niagara market, where are places that still have ability to get in by GO train, and accessibility around it. So these are markets that I'm, really looking at right now. The downtown Toronto has me doing lots of research around it because I think it's fascinating. I think if you do go and live in Collingwood, you may actually need that bachelor apartment in downtown Toronto if you're going to live that lifestyle. So that's going to create some interesting investment opportunities to even start to think downtown, because most of us miss that downtown ability to get into that market, and it will come back. So it's just really doing your homework and looking at, where's that good price point, really getting to that first time buyer, and that segment of affordability will always seems to serve you well.
Cool. Raja, do you have any tips on people? Where should they buy? What would you advise?
Actually, as Brian said, is affordability. See, wherever you buy, that depends on each and every individual's purpose. If you are working downtown, if you are single, of course you want to live in downtown. If you are family with the kids, you want to live outside, suburb. See, everything depends. Actually, the answer, okay, and also if you're buying for investment, if you are going to live in, you want to, you want to bring your family up, everything changes. So these answers individually we have to take a decision. That's what from my experience, I can say that.
That was actually very well put, because I think earlier in our webinars, we have talked about how real estate is both a consumption and an investment good. If you're thinking about living in the house, the parameters are very different. A little bit of rationality also goes out of the window when you're deciding to live in it and make it a home, versus when you're thinking of it as an investment property. So, but I feel like a lot of areas, like Brian was saying, like St. Catharines, and we actually have a property around that area in Welland on the BuyProperly platform, have become suddenly interesting and attractive. Like, I would have never thought about Welland. Like, I didn't even know how far it was. Like, yeah, it's somewhere there. But now we have a property there that we think is attractive and willing to evaluate. So suddenly it has kind of broadened my own horizon on how far I will go to actually invest in a property or buy a property. And with COVID and with the COVID restrictions, I think more platforms like ours will probably come in where people are buying into properties without actually physically going there. So further out than a driving distance. There's a US survey which says about 60% people surveyed said they bought a house without actually physically viewing it, just remotely online. So I think not only are people willing to explore further out areas, they're also willing to explore making data-backed decisions without actually driving out and going to those places. Clearly opens up the number of factors that go into this decision. Nigel, any tips, thumbs of rule that people should follow?
Sure, I'll perhaps provide a more top-down perspective here, right? And I'll bring it back up to kind of a macro outlook. And what really determines affordability is your debt servicing ratio, how much of your income has to go towards servicing debt. So although real estate prices have gone up, the amount of income that goes towards debt hasn't drastically increased because rates have declined, right? So that isn't expected to change anytime soon. We're not expecting rates to move up substantially anytime soon. So we don't think interest rates are going to be the driver of a rapid change in debt servicing costs. What could change though is unemployment, right? COVID isn't fully over, so unemployment might tick up again. We might see another wave of white collar layoffs. We've only seen part-time unemployment, and blue collar people get laid off during COVID. So we have to wait and see whether more broader economic unemployment occurs. So when we think about the real estate market specifically, now I won't get into owning versus investing, I'll defer to the panelists, but the most important metric is months of inventory. Months of inventory is what determines pricing. And where we are today is about 1 month of inventory or lower, at least in Toronto from what I've seen. And that translates to about a 20% increase in prices. So we should continue to see fairly strong price appreciation over the next 6 months, unless that metric goes to, let's say, 4 or 5, you're not going to see softness in prices. And the only way it gets to 4 or 5 is if we get significant listings driven by financial hardship. So these are either businesses that, like small businesses that have secured loans using their residential real estate. So the residential real estate is collateral for a small business loan, or individuals that are now facing hardship because of a second wave of COVID and they need to sell their property, right? So if a substantial portion of people that either have investment properties or own a property face financial hardship, small business owners or individuals, that could lead to an increase in supply, but we're not seeing that yet. And we won't see it for at least a few more months because deferrals just ended in October and November. And a lot of households, like we said, built up some savings. So they first have to run through those savings, and then it takes 90 days after that for them to go delinquent. So it's possible that we might not really get delinquencies until the summer of this year. So the summer of 2021, I think, will be a key and important time period to see how the supply and demand of real estate could unfold.
Interesting. We have a very specific question, and I guess Brian and Raja, looking at you guys, it says, what do you think of places like Chatham and Windsor in terms of buying? So somebody is looking for advice on these two locations in particular. Either of you, Raja, do you have anything? Brian?
Yes, Brian, do you want to answer or you want me to answer?
Go ahead.
Okay. Actually, last week, one of our agents put an offer in Windsor. You cannot believe that. Not only that, not one offer, 3 offers. All 3 times he's lost. So see, now everywhere the price is the same. Everywhere the multiple offer situation. We cannot say where you can find even. See, there are 2 ways you can look at it. Somebody went to Sault Ste. Marie to buy a property. Their monthly, they're getting $1,000 cash flow, but the appreciation will not be much. See, the thing is, you have to be thinking 2 angles. Either you are thinking to cash flow or appreciation. I believe if you live there, you don't need to worry. But if you are thinking to investment, cash flow as well as in the price appreciation where it is, where you have to put your money. But when you say wins, this is, and also the person is, the question who asked, is it the purpose of investment, planning to move in there? Then only we can give the proper answer. This is my opinion.
Brian, what's
Yeah,
your
no, you're spot on. And when we look at markets outside, obviously being more a GTA expert, I tend to look at what are the rent to your average price trends. We've seen a number of clients going out the Windsor way just because there had been such a really good buying opportunity. Where a lot of we're seeing right now is new construction. I haven't been excited about new construction in about 6 years, and then in the last 3 months, I've been all over looking at projects because they're now starting to make sense, because the builders are actually pricing the projects relatively well, and you have a 3-year trajectory and 5 maybe for some condos around it. So it's just really understanding the due diligence that you need to do on a per project basis and understanding the market. But new construction, people are going in droves buying new construction properties, but you just really have to have the analytics and the data to make sure that you're making a good buy when you're doing these.
Cool. Yeah, I think while we are talking about geographies, maybe I'll run a quick poll, because we are bringing a lot of these suburban markets on our platform. So wondering if people would like to know about some of them. Windsor is actually one area that we are looking to add a property very soon for people to invest in.
One quick point I just wanted to make about,
Yeah.
I think, the work from home trend. Generally speaking, I think in order for that to be permanent, a technology that would be critical to enabling that is going to be autonomous driving. Like, autonomous driving needs to become a mainstream technology if people want to kind of move away from this idea of centralized cities like Toronto. Because if you can get in your car, set it and forget it, and if it's a 2-hour drive, you don't care. You can work in your car, you can sleep in your car. It doesn't really matter. So I think if we're looking like over the next 50 years, if you want a permanency of work from home, I think autonomous driving technology is going to be critical to enabling that.
Cool. All right. Yeah, I think the person who asked about Chatham and Windsor is mentioning it's for investment and looking at multifamily rentals. And since we're out of time, the last question to all of you, and we'll go around in the circle, is what are the resources somebody who's interested in purchasing either a home or even an investment real estate should use to become more aware? Because this was a very, very data-backed, potent discussion, and this people don't have access to all the time. So what resources can they look at? We at BuyProperly, of course, put out blogs, we try and do our research, and we do webinars. So that's one forum where we're constantly trying to update our customers and potential customers. But what other resources would you guys recommend? Brian, do you want to kick it off?
Yeah, sure. You know, the real estate professional on your team is the most critical, and your platform's Khushboo for sure. Our company at Insightt, what we've created is actually visualization of the data. So you can come onto our website, it's Insightt.ca with a double T, and we show average price trends, we show rental trends. We're just showing that information just so the average person and actually the real estate professionals just have access to information a lot easier at the click of the mouse. So it's really just information. The more that you have in understanding what the housing market is doing, what the rental market is doing, and then you have guys like Nigel really giving us good overviews around the macro things that change the overall marketplace that gives. But knowledge is power when you're buying. The better the people you work on your real estate team with, the more successful you tend to be.
Awesome.
Yeah, there is a proverb, right? You get what you pay for. Experience always matters. I have enough examples in my life to support this. Always approach an experienced person in any field. For example, if you want to buy or sell your property, find the right approach and find the right real estate agent or real estate broker. Then approach an experienced, knowledgeable realtor is the right choice. I would suggest subscribing a newsletter and magazines, read books on real estate matters. Also, you may consider to joining REIN, REIN group, and so on. Thank you.
Nigel, Anything to add?
So of course, refer to real estate industry experts like Brian or Raja if you want industry specific advice. I'll tackle this more from a personal finance perspective. I think, before you make any decision, you should really have a strong grasp on your monthly budget costs and your fixed costs versus your variable costs. You should have an understanding of the available income you can dedicate to servicing debt. Know how to use a mortgage calculator in Excel, or use one online if you don't know how to use Excel. And just stress test your sensitivity to interest rates. Stress test, interest rates going up by 0.5% or 1%. And you can do that for rental or property that you own, just to see what the cash flow impact could potentially be for you. So my advice would be simple. Don't take your current cash flow situation and assume it'll always be that way. Try to stress test it. Try to see how much margin of error you have. Understand what the drivers are. And then once you do that, you probably have a better sense of what you can afford, and still give yourself a margin of safety so that you don't run into cash flow pressures down the line.
Awesome. Thank you, everyone. This was a very, very insightful, data-bagged discussion. I wish we could go on forever, but I know I'm mindful of time. We're out of time. Thank you for all the attendees for joining us and for all the questions. If we did not get to your question, feel free to email us and we will reply on email as well. Thank you, everyone, and have a good day. Thanks, Brian, Raja, and Nigel.
Pleasure. Thank you.
Thank you.